A lot of people try to find one perfect investment strategy they can set and forget for their entire lives. That approach usually backfires. A strategy perfectly calibrated to build wealth in your 30s will actively jeopardize that same wealth in your 50s. Retirement planning is a continuous negotiation between three variables: your growth potential, your risk exposure, and your time to recover. This graph tracks a portfolio over 30 years. Notice the sharp 40. Successful retirement investing requires actively adjusting your risk exposure as your runway inevitably shrinks. In your 30s, you are likely capital poor but time rich. This makes massive compound growth your primary objective. This comparison matrix maps out the decades. Column 1 shows the 30s. Because you have decades to recover from market crashes, your allocation should sit heavily in equities, typically 80 to 90% stocks, optimizing for maximum compound growth. To get that kind of growth, you have to absorb severe short-term market volatility. Drops are guaranteed. The most reliable way to survive those drops is to fully automate your contributions. When money moves into the market automatically every payday, you remove the emotional reaction to negative daily headlines. You also have to give up on trying to time the market. Consistent, automated investing ensures you capture shares at all price points, averaging out your costs over the long run. A market crash won't ruin your retirement in your 30s. Failing to use your massive time advantage because you paused your investments will. Your 40s transition you into your peak earning years. Chasing a slightly higher percentage return matters far less now than total contribution volume. Returning to our matrix, the second column opens for the 40s. We slightly adjust the allocation to 70 or 80% stocks. The new primary metric is maximum capital injection. Your income will likely rise during this decade, creating the temptation to inflate your lifestyle. Every annual raise should instead be funneled directly into base capital accumulation. This chart compares two financial moves. On the left, credit card debt creates a guaranteed negative 20% yield. On the right is the historical average positive return of the stock market. Paying off expensive debt mathematically beats nearly any market asset. You also need to diversify the capital you are injecting. Spreading your investments across U.S. stocks, international markets, and real estate buffers your portfolio against single-sector crashes. The trade-off here is deliberate. By diversifying, you accept average market returns and abandon the attempt to pick a single breakout lottery ticket stock. Your ultimate wealth in your 40s is determined by your savings rate and your ability to plug guaranteed capital leaks, rather than purely by portfolio performance. By your 50s, the dynamic flips. You are now capital rich, but time poor. An imminent market downturn replaces long-term inflation as your primary threat. Our matrix expands to the final column for the 50s. We see a structural shift toward 30 to 40% bonds. The core metric is now capital preservation. You are deliberately capping the maximum upside growth of your portfolio. In exchange, you drastically reduce your overall volatility. This is also the decade to build a substantial, highly liquid cash reserve completely outside of your market investments. If a bear market hits alongside an unexpected medical expense, holding cash prevents you from liquidating your stock positions at the exact bottom of the market. You have to stop viewing your portfolio strictly as a growing pile of money. You must start engineering it for predictable retirement income distribution. Winning the investing game in your 50s means ensuring a poorly timed market crash cannot erase decades of compounding right before you need the capital. Financial success requires matching your behavioral habits directly to your specific timeline coordinates. This life stage audit identifies imminent threats. 30s, waiting instead of embracing volatility. 40s, lifestyle inflation and toxic debt. 50s, remaining overly aggressive and ignoring income. To catch these errors early, run an annual progress calculation to measure your current savings against your projected retirement needs. Because of this, you must continually make incremental adjustments to your portfolio's risk profile as the years inevitably pass. An investment strategy is a living mechanism. By continually adjusting the dials of risk and growth relative to your age, you guarantee that compound math secures your retirement.